Welcome to This Week in Money. I'm Jim Goddard. Today, Greece staves off its economic crisis for now. CIBC Wood Gundy's Ross Clark comments on that, and record highs for the equity markets. Ross Kay of Ross Kay Realty Consultants claims international critics have overestimated Canada's so-called real estate bubble. We talk to Ross Clark right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome to This Week in Money.
Thank you, Jim.
Well, it looks like, again, all-time highs in the equity markets and perhaps some semi-good news, and I'm using the word semi-good news for Greece.
Yes, I mean, here we are as of Friday. They've come to some type of a resolution with the Greek debt to find a way to push it forward. Now, it's still the early part of next week, Monday, Tuesday. They're going to have to get the institutions to agree to the plans. But this is just going to push it out another 90 days. And, once again, we'll be down to the wire and talking about this one, I would think, in the month of May. But for now, they're looking to pull another rabbit out of the hat. And with that, we saw the previous week or two that things were loosening up as far as the high yield market was concerned with the bond market, which was indicative of a risk on kind of attitude coming back. We'd spent months here consolidating really since October, and some downside pressure into December with some tax selling. But 2-3 weeks ago, as the long bonds, the treasuries, were down to exceptionally low yields and started to turn. And at the other side of the coin, the higher yield items were starting to drop off in terms of yield. You could see that there was this market was going to have some life to it. So we end up this week with the Dow Industrials, new all-time high, the S&P also at a new all-time high. Led by biotechs, technology, healthcare, just leading the pack on the upside. And even, the NASDAQ, here we are, back in the first quarter of 2000, the NASDAQ was at the levels that we're seeing right now. And it took a while, but if NASDAQ can close at this point at the end of the month, it'll be the best monthly close in the history of that index. And from the depths of the 2002-2003 lows, this has been quite a comeback.
Now, so many people keep telling us we're on the precipice, we're on the edge of a very big drop in the equity markets, yet they keep climbing. What is powering them?
Well, it's hard to say what it is at any given point, and it's perceptions of problems that you always have to be concerned about. Looking at all the negatives and not realizing that the market has got this liquidity that's driven by still these central bankers. My preference is to look at the technicals and see, are we healthy? Are there things that we should be looking at? We are now just coming up at the end of the 4-month period of the best 6 months of the year, that being November through the first week of May. It hasn't had a big upside bias as of yet, but it has been in there. Take a look at the month of March historically. We've had a pretty good run in Marches the last number of years. I think since 2009 we've had one down March. But when we look back, you see that about probably 30-35% of the Marches are corrective months. Even though you might end up finishing off the 6-month stretch on the upside, March can quite often be a month that you have to be careful. So, what we had looked at in the last couple of weeks is that coming off the lows, wanted to have upside momentum. We had that 2 weeks ago, nice turn to the upside. This week finished, as I say, with new highs and with a higher low. from my perspective, watching the bond market, watching the equities, I think it will be very important that it maintain this upward momentum. We don't want to see a reversal back down through this week's close. If we were to close below this week's low, I would take that as a negative. If we were at any point to penetrate the low that we had 2 weeks ago at 2041 on the S&P, that would be a concern for me. Another, piece that people have looked at for decades and decades now is Dow theory, which goes on the basis that the Dow Transportation and the Dow Industrial Average should, in a healthy market, make higher highs together. Each one should confirm the other. And we're in a position right now where they're both trending up, but the transports are lagging. And they're still about 100 points away from the highs that we put in back in December. And in the research that we've done, anytime that you're more than 6 weeks between highs and have a reversal with some divergence in there, which is what we could be setting up for, the corrections have been typically anywhere between 8 and 15% of the market. So we should be watching very closely here over the next 2 weeks to see if the transports can get up there and confirm this move that we're seeing in the other indices. So, as I say, going back over the last probably 20 or 30 years looking at this, there's maybe 8 examples where we didn't get confirmation on the breakouts, and those were ones that required that investors, maybe not so investors, but at least traders, become very cautious.
Shouldn't this big drop in fuel prices have an impact on transport stocks?
Well, you would expect that they would. You've got the truckers are doing better. Some of the rails are doing all right. The airlines not doing as well as one might have anticipated. And of interest, when we take a look at the oil price and the hard breaks that we've had over these last couple of decades, the half a dozen ones that have been there, once the crude oil has made a low, and we can't be guaranteed that we've got the low in for crude right now. We did bottom out around 43.5, and we're sitting around 50 as of today. But once you have those hard breaks in the oil market, such as we've seen, and you start to base out, the equity market does like that declining price of oil. But once the bottom is in place, there typically is a high in the equity market within the next 4 to 6 weeks. Sometimes the corrections are very mild, but there are interim highs on a very, very regular basis just after that low is put in. So looking at where we are in the oil market with a low in place, if we go down and maybe retest that, come within a few dollars of it, I wouldn't be at all surprised that that might put a little bit of a lid on the equity markets again.
And what's the semi-good news for Greece?
The semi-good news is that they're going to allow them an extension. But gosh, the devil will be in the fine print, and the extension, the fine print on Monday, Tuesday will be important, but I think even more important will be when we get out to May, June to see what they can do for a longer-term model there.
Ross, thanks a lot for chatting with us.
More than welcome.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. You can contact Ross at ross.clark@cibc.ca. Coming up next, Ross Kay on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ross Kay from Ross Kay Realty Consultants. Welcome to This Week in Money, Ross.
Thanks, Jim. Nice to be back.
First question I have. The Canadian central bank rate was lowered. They cut mortgage rates in some areas, but not by much. Has that had any effect on sales here in Canada?
Has it had any effect? It might be a point of propaganda for your local real estate boards to try to encourage the current market to remain a little tiny bit busier than where it was trending. But in reality, no. At this point, with interest rates as low as they are and with affordability already stretched to the absolute maximum, the government has no levers left with interest rates. In other words, they can't lower interest rates enough that it is even going to remotely change the direction of the real estate market. You need a substantial cut in affordability to make that happen. That is impossible at the low interest rates we're already at.
Is there anything the government could do, or is it just a matter of the economy is slowing down on the prairies and the oil patch? It's ground to a halt and is negative. Could you affect prices in any other way?
Well, in terms of affordability, you can affect it. What CMHC, what the government is not aware of, is that the first-time buyers, which we call people initial acquisitions, so the first time you buy real estate, those people have basically been out of the market since 2013. Unless you have those initial acquisitions, your entire real estate market collapses, which is what we're seeing taking place across Canada right now. So Calgary, yes, the fear, the panic that set in over these plunging oil prices and memories of plunging oil prices in years past, coming into to people who owned homes back at that time, that has a causal effect of increasing the deceleration in the market that was already ongoing from July till December of last year. The reason that deceleration was already in place is because first-time buyers had already left the market. Without first-time buyers, there can be no real estate market. If you want your builders to be able to build new homes, that means you have to add more initial acquisitions into the market. There must be more first-time buyers being added to the market to support that increase in housing stock. Now, that doesn't mean that the builders have to build first-time or initial acquisition homes. On the contrary, where your builders should be heading today is building for the late baby boomer, those looking to retire or those looking to retire in the next 10 years, or those looking to downsize. Those people want to downsize, but they don't want to downsize in quality. They'll give up square footage, but they're not willing to give up the luxury of the home that they're in now. So they want the same lifestyle. They want the same attributes. They want the same benefits of where they're living. They just want it in a more controllable, lower cost alternative. So what your builders should be doing, which they're not, is that they should be focusing on those type of homes, or even homes at the middle stages of where people buy, the middle stages of their lifetime of ownership. In other words, when they've got their teenagers at the early teen years, those purchases that last about 6 to 8 years in your lifetime, builders should be building those type of homes right now too, if the demographics in your region equate to it. Builders shouldn't be focusing on first-time buyer homes. Your first-time buyer homes really should be focused on your existing inventory, and by adding those higher-priced homes or those the one that the baby boomers are going to move into, that naturally causes your price points throughout the whole string of housing types in your community to go lower. That increases affordability. That causes the first-time buyers or initial acquisitions to increase, which creates a healthy housing market. The housing market in Canada has not been healthy for over 2 years now. And there is no way for the Bank of Canada to avoid this contraction that's ongoing. It is just impossible, because you can't make initial acquisitions any more affordable unless selling prices decrease. That's the only way that that's going to happen.
What about the building of these micro condos where they're 500 square feet?
Well, for those of us who remember Brave New World, the micro condo should be something that you're very afraid of, because to put people in that small of a square footage of living space without the other attributes that are needed to have a healthy lifestyle, In other words, mentally and physically, you're able to develop as the human species is supposed to develop. These micro condos are going to create a real problem because people are going to buy them because they feel they can't buy anything else. Why can't they buy anything else? Because the housing market is stalled. There is no place for the baby boomers to go right now. So, you bought a house when you first got married. You had your kids, you moved to a larger house. Your kids got bigger, you moved to a larger house. You got a promotion. Your income increased. You moved to another house. Now the kids are going off to college. Okay, we got to start watching money, so we're not going to move. You get the kids through college. Now your kids are 22. They're no longer at university or college anymore. Oh, all of a sudden we have all this extra money. Even if the kids want to come back and live in the house for a couple of years till they get on their own 2 feet, that outgoing expense is no longer on those homeowners. So what have they done in the last 5 to 7 years? They've gone out and bought bigger houses, monster houses, because they've had those houses were affordable to them. I don't have to put $20,000 a year into my child's education. I can put that $20,000 a year into my mortgage payment. So they buy luxury homes. Those people now, they've had the luxury home for a few years. They're now starting to contemplate, where are we going to move after this? Do you actually think that they're going to move into one of those micro condos? No. Do you think that they're going to move into one of the entry-level homes in your community, one of the condominiums in your community? No. Where they want to move into is to an upscale condominium or an upscale shared living detached arrangement, a condo strata type with detached or semi-detached homes. That's where they want to move. They want those houses to be ultra luxurious. They don't care if they're 3,000 square feet. They'd probably be happy with around, 16 to 1,800 square feet, I think is what the number usually trends out at. But those houses have to be built to the highest quality standards. For a long-term living is ideal. In other words, everything's on one floor. You don't have to worry about stairs. There's a possibility of full basements so that you can have, at a later stage in your life, if you need someone to live in the house to assist you, that's possible. Those are the types of housing that should be built by the new builders. If they were to build that would allow those luxury home buyers to sell those luxury homes and move out. That allows the pent-up demand in the medium class of homes, the homes, the 4-bedroom, 2 stories, those type of homes, where their kids have moved on. That allows those people to move into the luxury homes. And it goes right down the sales chain backwards, naturally causing the smaller homes in a community to become more affordable to first-time buyers. Of course, you're looking at zoning bylaw changes. You're asking for rational governments to be in place that have a vision for this. You're asking for the builders to have a brand new mindset towards how they're going to generate revenue and sales. Because right now it's focused on micro condos. That's where it's focused on. Micro condos create the lowest job growth of any housing type that's available. What you want to do is you want to build the more expensive luxury homes that require more work hours involved in the construction of that home per dollar spent, instead of the opposite, which is the lowest employment cost per dollar spent on the purchase price of the home.
What kind of trends are we seeing in real estate across the country?
Well, the market has been cooling since last July. I think we've talked about in the past, Jim. Again, it's being obscured by crazy comments that are coming out, like how the 0.25% drop in interest rate caused the market to have a spurt in January in the GTA. The fact of the market is, Vancouver, all of British Columbia, all of Alberta, every place across Canada, including Ontario and the GTA, those markets are all decelerating. They're all heading towards negative. It's an unavoidable fact. There's no way to stop it. It's going to happen. It's just the natural outcome of any real estate market. So when you're hearing things out in BC about Vancouver's, I think they had Greater Vancouver Real Estate Board, 1911 sales for January was up over the previous year's January. Well, that's true. It was up over the previous year's January, but the point of the matter is it needed to be 200 higher than what was reported just to stay on the same pace that it was on in December. That didn't happen. So Vancouver's market is cooling. It is going to go negative. It's unavoidable. No matter what the real estate boards are telling you, that's a fact. Unless something has changed from 1985 till today in every single real estate market in Canada, these trends are irreversible.
Ross, taking a look at the Okanagan, their real estate very tightly connected to what's happening in Alberta. So what's happening there?
Well, if you look at Okanagan, so what people who live there should know is that type of a market is called a peripheral market. In other words, if you use a concentric ring theory or you use rings, you would have like an earthquake. Vancouver would be the epicenter. It would be the center of the earthquake. And then activity changes as you go from rings around from outside of Vancouver. The same thing for Okanagan. You'd have an overlapping peripheral market from Alberta, from Calgary. So you're what's called a peripheral market. So in a peripheral market, there's benefits and there's negatives. One of the benefits is that you don't usually see the radical change in home prices that you do in the primary markets. So your price won't increase and it won't decrease as a percentage the same way that it would in Calgary or Vancouver. So that's the good thing. You're also not going to see your sales swings be as radical. There will be times where money comes into your economy, like via vacation properties or something of that nature, that might cause a small cyclical change in your pattern, but the pattern itself still never changes. So in Okanagan, is it being impacted by Calgary, Alberta? Yes, it's being impacted, but that's a compounding effect. So in peripheral markets, there's a compounding effect. So you have the natural deceleration or acceleration in sales taking place, and then you have the impact of an outside influence like Calgary, Vancouver, hitting your market at a given time. So instead of Okanagan seeing your sales be 8% lower for the month of January, which is where you were trending from July of last year till January of this year, you should have seen an 8. In July, I would have told you that your January numbers were expected to be about 8% lower. You saw a 15% reduction in sales. That extra 7% reduction is a result of you being a peripheral market. So the impact on Calgary has followed out to your local market. But that also will only last for a short period of time, and your market will equalize as Calgary, that effect is no longer an overriding factor to your local market. So the benefits of being in a peripheral market are slower change, less radical change, and the fact that you, generally speaking, see your outcomes later than what your primary markets have. So that's one of the benefits of living in a peripheral market like that. It's until light rail transit becomes a reality across the world, these peripheral markets are always going to experience change along those patterns. They have since 1985. It's always been the same. It's the same your way as it is out in Ontario in the GTA. So Toronto will correct. It's the epicenter. Downtown Toronto is the epicenter. Outlying markets of the GTA like Oakville and Burlington and Hamilton, those markets are impacted when Toronto corrects itself. So in Ontario, you've got Hamilton and Burlington and Oakville already below January 2014 sales numbers. And once Toronto begins to contract, it's multiplied in those communities. So it's not just a BC phenomenon. It's not an Okanagan phenomenon. It's a phenomenon of being in a peripheral market.
We've had international bodies keep telling us Canadian real estate is overpriced by 30%. Is it?
Well, it depends on what price everyone is using. So the IMF, OECD, Bank of Canada, Central Mortgage and Housing Corporation, every bank in the country, apparently they want to use the average selling price of the Canadian Real Estate Association to determine what the value of the average Canadian home is. Anybody who's in a real estate market or looks at Realtor.ca today realizes that that just doesn't make any sense. So if your listeners were to go to Realtor.ca today, they would look on Realtor.ca and they would see that there's about 228,000 homes for sale. Now, I haven't checked this morning, but that's basically where the number should be around. 70% of those homes are below the average selling price of the Canadian Real Estate Association. So the Canadian Real Estate Association says the average selling price is around $408,000. 70% of the homes on Realtor.ca today are below that price. So clearly, when the IMF, OECD, CMHC, all of these people are making comments, it doesn't relate to the average homeowner. So your home has not increased in value the way that it's being reported to you by all of these bodies. If someone is going to use $408,000 as price as the average Canadian home, it doesn't make sense when 70% of the inventory for sale right now is below that price. It just makes no logical sense. But you have to understand how to read a real estate market to come up to that conclusion. That takes place on all these numbers. So what you really need to be looking at in terms of how much overpriced the market is. If you're going to start with $408,000 as your starting price, in other words, you're going to use the average selling price, then obviously there's more room available to talk about a decrease or overvaluation. If you want to look at a more realistic view of home prices in Canada, something that would come in, maybe around 360,000, 365,000, then you remove automatically $40,000 right off the top. So 40,000, that's a 10% reduction from $408,000. So all of a sudden, a 25% claim of reduction in of overvaluation drops to being realistically speaking, it's really only 15%. So these big numbers that these people are talking about are just not numbers based on the truth. They're based on not knowing how to read the Canadian marketplace. Canada, as I think I've said on your show before, it's the only place in the world where these real estate statistics are collected, calculated, and reported in a manner that allows independent interpretation of those numbers to take place. Why there's not an independent interpretation, I don't know. They're being interpreted in 2015 the same way that we created them back in 1985. We created them in this way back in 1985 so that the consumer wouldn't be misled. That was the original intent of these numbers. Average selling price. Well, you could report that back in 1985. Nobody had a computer. Nobody was reading 5 different websites in a day getting their news reports. They weren't listening to 50 different types of radio stations available to them. It was just not a problem back then. What it did back then is it sort of modified the market. In other words, people could hear these numbers and they could be pretty comfortable with them. That's not the case in 2015. When they hear those numbers today, they believe they're the truth. When they hear those numbers today, they don't read the underlying disclosures that are attached to all of those numbers. And that includes the OECD claims, that includes the IMF claims, that includes CMHC, that includes everybody. Obviously, these people aren't simply reading the disclosures that are included when this information is released to the public. So the Real Estate Association says it's the average selling price. It doesn't say the average home in Vancouver is worth this amount of money. It said our members, as salespeople, sold this many houses last month, and this was the average selling price that those houses sold for. Somehow, that number, which was created over 30 years ago, just to give the public a little insider view on the real estate market, has become the number that everybody looks at. So that 25% over inflation they're talking about, really, it was only a 15% over inflation. Now, all that being said is, I think their numbers are off too, because even to come up with these random numbers of like 25%, I think we heard 60%, from one of the big foreign think tanks earlier or later in 2014. Those numbers are not relevant to the Canadian market. They may be relevant in France, they may be relevant in Greece, they may be relevant in England, but they're not relevant in Canada. We have rent controls in place in most provinces. We have very, very small, minimal growth through our rental housing stock for the last 20 years. The way that our houses, our housing planning and development takes place, it's not the same as it takes place in Europe. So when they come up with a 60% over evaluation that's based on selling price to rent ratio, it simply is not a relevant number in Canada, because the house that someone's living in Canada, if it was a brand new constructed home, may rent for $4,000 a month. But the fact that it was built 7 years ago and has been rented for 7 years, they're only able to rent it out for $2,000 a month because of rent controls. None of those things are taken into place. And that's where the problem with all these overinflation numbers you're hearing about come into play. It's why any of your listeners today should not listen to any of these people who are commenting about overinflation unless those people provide you with documentation to how they came up with their calculation.
Ross, the last few shows that we've done with you, you've always explained the advantages of using a real estate consultant as opposed to a real estate agent. Again, could you maybe outline some of those differences?
Well, what a real estate consultant or a real estate advisor, if you have one that's qualified, now that's a challenge in itself. They're able to tell you what's going on in your marketplace today, yesterday, 2 months from now, and 6 months from now with a pretty high degree of certainty. So in other words, had you been using my services and you lived in the Okanagan and it was July and you said, hey, Ross, what's happening with the market? I would tell you that your market was contracting and it was set to turn negative in January. You would not have heard that anywhere else. There is nowhere in Canada that you can find that reported other than with my company. That's because we track markets in a totally different manner. It makes no difference to a consultant whether or not you move. You're going to pay a consultant whether you move or not. You're going to pay them if you're going to buy a house. Whether or not you end up purchasing a house or not is irrelevant. You're going to pay them a fee for their consulting services on that purchase or that sale. So that's what the difference is. There is no benefit to someone with my firm giving you advice because they need the sale. All of our buyer clients in Canada right now, so almost all of them, I mean, it's not 100%, their instructions right now are to hold. Do not buy a home. If we were a traditional realtor, or we were obligated under the rules of being a realtor, we couldn't give you that advice. If we gave you that advice, that meant that we'd have no bread on the table tonight when we got home with the family. If people want independent advice from experts, they should find an expert, and I mean really vet the person, and they should pay them, because you don't have to pay them very much. Those experts are going to save you literally tens of thousands of dollars if you're buying or selling a home. Let's say you're selling a home. If you used a realty consultant with our firm, that realty consultant would outsource all of the aspects of selling your house. So you wouldn't be paying a commission rate. You would pay up front a given fee, which is predetermined. How that fee is going to be spread is also predetermined. So if you're told that you're going to have a $2,000 marketing package created and prepared for your home, you're going to see a $2,000 marketing package prepared and completed for your home. In Canada today, 2014, the average home seller, successful home seller in Canada, in other words, those people that were listed for sale and sold their home, were then obligated to pay. The monies that they paid, only $567 went to actually marketing their property. The reason for that is all of those successful sellers had to pay for the other 62% of sellers that never sold. So on Realtor.ca today, if you go on there today, you're going to see about for round off numbers, 230,000 houses for sale. Of those 230,000 houses, about 32% of them are going to sell. 32%. So we're going to round that off to 30% to make the calculations a little bit easier. And we're going to take it down to 200,000 houses for sale to make the calculation a little bit easier. And we know then that 60,000 sellers on Realtor.ca today are going to pay for the real estate services of all 200,000 people that have their houses for sale on Realtor.ca today. What houses sell in a community? They're the houses that are priced right. They're the houses probably located in the better location, which goes back to price. They're the houses that probably were upgraded the most. They're probably the best house in the street at the fairest price is going to sell. Why are those people forced to pay for the other 68% who have the worst house on the street? They've overpriced it. They don't want to have their home staged. They don't want to do what's necessary. Why should the successful person have to pay for the failure? But that's the way that real estate is bought and sold in North America today. With a consultant, you bypass that 68% expense. So you can reduce the cost of selling your home by 68% simply by hiring a real estate consultant. You still use a realtor because the consultant outsources that little tiny bit of the procedure that is required to be handled by a realtor by, in your case, the BC Real Estate Association, or the governing body for realtors in BC. So that little tiny piece is outsourced to a realtor. Everything else is done by experts. How many real estate people in your community, how many realtors in your community have gone to university or college and taking marketing courses, advertising courses, negotiation courses, philosophy courses, psychology courses? How many realtors in your community have done that? How many realtors are trained as home stagers, building inspectors? How many? Probably none. And in the whole package of costs, there's probably not a single realtor in your community who has been trained in all of those things. Yet you're going to turn over high commissions to them to do it. There's a reason why only 68% of the homes that are going to be posted on Realtor.ca this year aren't going to sell. That's because the realtor, who is commission-based, must list 100 homes to get 32 sales. That's why.
How can a person find out more about real estate consultants and how they work and how they might hire one?
They can email me directly from rossk.com. We can help you out because we have no branches set up out in BC today. We will not have a branch set up in BC today until we are assured that whoever is operating it is able to operate under our standards. We are a centralized process. In other words, in order to ensure our clients are treated in the way that they should be treated, everything is handled at head office. So our data collection takes place locally, but it's analyzed in head office. People who you are dealing with from our firm are only authorized to talk about the information that we give them. They don't care what the real estate board says. They don't care what the Canadian Real Estate Association says. They don't care what CMHC says. They use our calculations to give you advice. Now remember, our calculation was the only one who warned Okanagans back in July that your market would go negative in January, which it did. Also, all of our outsourcing takes place from head office. So we have a marketing team that creates marketing materials in-house. These are experts. This isn't some realtor with a laptop and Microsoft Office installed doing feature sheets that were done 30 years ago. These are high-tech, qualified people that you would have more of a tendency to see representing builders in your community than you would ever see representing a single home seller. So what we're doing on the marketing side and the selling side is the same tools that a builder has when he's selling 100 homes are the tools that we're bringing to the consumer. And they only have to pay the going price for that. They don't have to pay that extra 68% that never sells. So we're going to handle those things in this manner until we're able to open a branch in each of the communities across Canada. And even at that time, everything will still be functioning from head office because that's the only way that the consumer can be protected.
Ross, thank you very much for speaking with This Week in Money.
Thanks, Jim.
Ross K Realty Consultants, their website, rossk.com. Well, that wraps up our show for this week. I'd like to thank our guests, Ross Clark and Ross K, and thank you for listening. If you have any comments about the show, you can send them to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.